Why is traditional investing broken for most people? Before we dive in, I want to ask a question. If you invest consistently every month, get a reasonable return, and stay patient over time, will that actually be enough? Enough for the retirement you want, for the financial independence that you actually picture when you think about what your future looks like? Most people don't know the answer to that. Not really. They hope it's yes. They've been told it's yes. They're following the plan that they were given: a company pension, a retirement account, maybe some exchange traded funds or index funds, maybe a mutual fund that the bank set up for them years ago. And they're trusting that it all adds up to something meaningful at the end. And that trust may be well placed. But most people have never actually checked. They've never run the numbers from their current situation to a specific retirement outcome and verified that the two connect. They're investing on faith. Faith in the system, faith in the market, faith in the advice that they were given. Well, today I want to test that faith. Not to undermine it for the sake of it, but because if the math doesn't work, the earlier you know about it, the more runway you have to fix it. And if the math does work, well, you'll have more confidence in what you're doing, which itself has real value. This is the first episode of the Investing Project. This channel is going to be different from most investing content you'll find online. We're not going to tell you which stocks to buy this week, and we're not going to predict where the market's going. We're also not going to offer hot takes on the latest economic news. But what we are going to do is build a complete, systematic approach to generating real wealth, from the foundation up, with real numbers in real markets, documented live so that you can watch it work or watch it struggle and learn from both. We call it the three-engine wealth system. And this entire first module is about building the mental framework, understanding how the system is structured, why it's designed the way it is, and how the three engines work together to accelerate wealth building in a way that traditional investing cannot. But we are not starting with the solution today. We're starting with the problem. Because if you don't fully understand what's broken about conventional investing advice, then the solution won't make complete sense, and you won't have the conviction to follow it when things get uncomfortable. So here is how today's episode works. I'm going to give you 4 questions. Now, these 4 questions represent the 4 foundational assumptions that traditional investing relies on. Now, if all 4 of your answers are a clear, confident yes, well, then your plan is probably working, and this series will still add significant tools to your toolkit. But if even one answer is no, or I'm not sure, then your plan has a structural gap. And a gap that you're aware of is always better than a gap you're not aware of, because gaps can be fixed. So let's go through them one at a time. Question 1. Do you have enough surplus income after every must-pay expense in your life to fully fund your investment account every month? And I don't mean just contribute something. I mean fully fund it. The amount you actually need consistently to hit your goals. For a substantial number of people watching this, the honest answer is no. Or it's yes in good months and probably not in bad ones. Look, I get it. Life is expensive. And the gap between income and obligations, things like housing costs and food and transportation, insurance, childcare, debt repayment, everything else, the gap doesn't always leave what a serious investment plan requires. And here's why that matters so much. Traditional investing is built on the assumption of a consistent, meaningful monthly contribution. The entire power of the model depends on it. You put money in every month, the market grows it, and decades of compounding do the heavy lifting. If you happen to pull a meaningful contribution out of that equation, or make it inconsistent, and that model degrades significantly. The math still works, it just produces a much smaller number at the end. So if your contribution is smaller than it needs to be, or less consistent than the model assumes, that alone is enough to create a meaningful gap between where you're headed and where you want to end up. Question 2. And question 2 has 2 parts. It's actually 2 sides of the same coin, actually. So 2A, do you have sufficient years remaining before you need the money for compounding to grow it to the size you require? Compounding is genuinely powerful. Given sufficient time, even a modest rate of return produces impressive results. A 30-year timeline at 7% turns $100,000 into over $700,000. That's real money from a standing start with no additional contributions. The problem is the phrase, given sufficient time. The traditional investing model was largely designed for people with 30 to 40 years of runway. Now, if you're in your 20s and just getting started, that timeline is available to you. But if you're in your 40s or your 50s and your retirement savings are not yet at the level they should be, you may have 15 or 20 years at best remaining. And that's not enough time for modest returns and modest contributions to close a large gap. You need something more. Now, there's a second dimension to this, which is that the model doesn't just assume you have time. It assumes you have consistent time. No major interruptions. No years where you pulled money out due to a job loss or an emergency. No divorce. No illness. Look, real life introduces interruptions that the model doesn't account for, and each one costs compounding time that is very difficult to recover. Now, question 2B, the other side of that same coin, are your returns high enough to compound your money in the years you have remaining to meet your actual estimated needs? The broad index funds have returned somewhere between 7 and 10% annually over long historical periods, depending on which index you measure and which time window you use. And that sounds solid. And for someone with a long time horizon and strong contributions, it often is solid. But here's the question most people never ask. Is 7% enough on your actual current balance with your actual contribution rate over your actual remaining timeline to produce the number you actually need? The answer, when people run it honestly, is frequently no. I mean, it's not always, but frequently. Because 7% on a small balance over a short timeline produces a small number. The math is not on your side if two of the three inputs, balance, timeline, and rate of return, are constrained. Now, question 3. Are your estimated retirement needs actually sufficient once you factor in realistic inflation? This is the one that gets the least attention, and it may be the most important. Most retirement planning models use an inflation assumption of 2 to 3% annually. And in some periods, that's reasonable. But look at what has actually happened to the cost of housing, to food, to healthcare, to energy, to the basic services over the last 15 years. 2 to 3% is optimistic in many of those categories. The compounding problem works in both directions. If your investments grow at 7% annually, but the cost of the lifestyle you want grows at 4 or 5% annually, your real return, the one that actually improves your purchasing power, that's like 2 to 3%. And 2 to 3% real return on a modest balance produces a much less comfortable retirement than the headline number suggests. You can be doing everything right on paper, investing consistently, getting decent returns, staying patient, and still be quietly losing ground in real terms because the goalposts are moving faster than you're running. So that's 3 questions. And there's a hidden fourth one embedded in the third, which is whether your estimate of what you'll need is even accurate in the first place. Most people underestimate retirement costs, particularly healthcare, in later years, and the simple reality that a long, active retirement is expensive. So there's 4 assumptions, 4 potential holes in a plan that otherwise looks responsible and disciplined. Now, if all 4 of your answers were confident yeses, I mean it when I say you're probably in good shape. Keep doing what you're doing and use this series to add to your toolkit. But if any answer gave you even a moment of hesitation, what you have is a plan that relies, in part, on hope. And hope, as a strategy, has a very poor long-term track record. Now, let's make this concrete, because abstract problems are easy to nod at and then set aside. So here's a scenario that accurately represents a large number of people who are doing what they've been told to do. You're investing, say, $500 a month. You're earning 7% annual return, which is roughly in line with what the broad market index funds have historically delivered over long periods. You have 25 years until you plan to retire, and you're starting today. At the end of those 25 years, with consistent contributions and consistent returns, that plan produces approximately $400,000. Now, depending on exactly how you model the compounding, it might be 410,000 or 420,000, but call it 415. Now, here's the critical question. Is $415,000 enough to retire on? Now, using the 4% withdrawal rule, which is the standard financial planning guideline for a sustainable retirement income that doesn't deplete your principal, $415,000 generates approximately $16,600 per year in retirement income. That is roughly $1,380 per month. In today's dollars, $1,380 per month is not enough for most people to live on in most cities in North America. It is not enough to cover housing, food, transportation, healthcare, and a modest quality of life in any major urban area. And here is the inflation dimension. That $1,380 is in today's dollars. The actual dollars you'll have in 25 years will have significantly less purchasing power than today's dollars, depending on the inflation rate over that period. At 3% annual inflation over 25 years, today's $1,380 has the purchasing power of approximately $660 in today's money. At 4% inflation, it's closer to $550. The income stream the plan produces might look adequate in nominal terms, but it is considerably less adequate in real terms. Now, I want to be precise about what I'm not saying. I am not saying that traditional investing is worthless. I am not saying that everyone's retirement plan is a disaster. There are variables in any individual situation that change the picture significantly. You might have a government pension income. You might have a company pension. You might have real estate equity, or a higher contribution rate, or a longer timeline, or an inheritance. Any of these things can improve the outcome. But what I am saying is this. For a specific but very large group of people, people who are investing what they can afford on the timeline they have in conventional vehicles, the default plan does not produce the outcome they're picturing. And most of them have never run the numbers to check. They are investing on faith in a system that was designed for a different set of circumstances than the ones they're actually in. And that gap between the system's assumptions and their reality, that gap is what creates the problem. The conventional advice, diversify, contribute regularly, stay patient, trust the market, it's not bad advice. It's just incomplete advice. It's advice that works well when all four questions have confident yes answers, and when the world cooperates. It assumes stable inflation, uninterrupted contributions, no catastrophic market events at exactly the wrong moment, and a long enough runway for compounding to do its work. But take away any one of those assumptions, and the plan underperforms. Take two of those assumptions away, and the gap becomes very difficult to close on the conventional plan alone. When the conventional plan is insufficient, it needs to be supplemented by something more active, more deliberate, and more capable of generating results in a compressed time frame. And that is what the three-engine wealth system is designed to do. Now, when most people here take a more active role in your investing, well, three objections immediately come up. And they're legitimate objections, and I'm not going to dismiss them. But I want to address each one directly because the case for active investing depends on whether they can be resolved. The first objection is, I don't have the expertise. I'm not a trader. I don't understand options or how to evaluate a company properly or how to think about speculative positions. The people who do this well have spent years building skills that I simply don't have, and I can't see how to close that gap. Well, this is true. Expertise matters in active investing, but there is a critical distinction between having expertise and accessing it. The model we introduce in this series, which we call the Virtual Investing Organization, is not built around you becoming a solo expert in every discipline. It is built around you identifying the expertise you need, finding people who already have it, learning from them in a structured and deliberate way, and developing your own judgment over time through guided practice. You are not starting from zero and building alone. You are operating more like a general manager, assembling a team of specialists and coordinating their input into a coherent system. That is a fundamentally different task and a much more achievable one. The second objection is, I don't have the time. I have a job. I have a family. I have obligations. I cannot add a second career managing a trading account on top of everything else. That is also a real constraint, and it's worth taking seriously rather than hand-waving away. And here's the honest answer. The time requirement for active investing depends entirely on what kind of active investing you choose to do. Some approaches are genuinely time-intensive. Day trading, for example, that can consume a substantial amount of a workday, but others are not. There are systematic investing strategies that require an hour or two per week, sometimes per month, once they're established. And these are income-generating approaches that can be executed in focused sessions that fit around a demanding schedule. There are speculative positions that you set then and monitor briefly on a weekly basis and revisit on a quarterly or annual review cycle. The point is that the three-engine wealth system is a framework and not a prescription for a specific daily routine. The specific strategies you choose to implement within each engine depend on your time commitment. And that choice is yours, based on your situation, your schedule, and the mentors you choose to work with. Part of what the virtual investing organization model helps you do is find mentors whose approach actually fits your real life, not an idealized version of it where you have 3 or 4 hours every morning. The third objection is, I don't have enough capital. You need money to make money. I can't afford to put large sums at risk in active strategies, and if I lose what I have no safety net. Well, this one also depends heavily on the approach that you choose. Some active strategies require meaningful capital to operate effectively, but others can be started with very modest amounts and scaled as the account grows. What the three-engine wealth system requires is not a specific dollar amount. It requires a scalable approach, a method where the same principles that govern a small account also govern a large one, where the percentages stay constant and the absolute numbers grow as the system generates returns. The capital requirement of your specific implementation depends on the instruments and the strategies you choose. And we'll be transparent about what ours require in the context of the $1 million experiment, which we'll talk about shortly. And we'll explain the logic behind every sizing decision so that you can apply the same logic to whatever approach fits your situation. But the system itself does not dictate a minimum. The approach you choose does. And that is a choice that you make with full information, not one imposed on you by the framework. These three obstacles are real, and I respect anyone who raises them. They stop a lot of capable, motivated people from taking a more active role in building their wealth. And not because the people lack the ability, but because no one has given them a framework that honestly addresses the obstacles rather than pretending they don't exist. That is what this series is here to do. So what is the solution? The three-engine wealth system organizes wealth building into three distinct but connected components, each one with a different role, a different time horizon, and a different risk profile. The first is the income engine, active trading that generates consistent monthly cash flow. What you trade is your choice. Stocks, options, futures, foreign exchange, whatever suits your skill set, your schedule, and the mentors you choose to work with. The engine's job is to produce reliable income, but how you power it is up to you. The second is the growth engine, systematic investing that takes the income generated by the first engine and compounds it into a growing capital base over time. Again, the approach is yours. The wheel strategy, value investing, dividend investing, real estate investment trusts, there are many vehicles. The engine's job is to compound. The method is your choice. The third is the accumulation engine. Asymmetric, venture-style positions in opportunities where the potential upside significantly exceeds the downside. Emerging technology, cryptocurrency, commodities, early-stage sectors. The thesis is yours. The engine's job is to capture long-term, outsized returns on a portion of your capital. Each engine supports the others. Income fuels growth, growth funds accumulation. The system becomes self-reinforcing over time. Now, the $1 million experiment I mentioned earlier, this runs in real time on our second YouTube channel. This one is the specific implementation of this system. Our choices of instruments, strategy, and opportunity are documented there in full, but they are our choices, not the system's requirements. The next episode maps the full framework, So like and subscribe to this video to make sure that you get notified when the next one is available, because that is where it starts to get specific. We're going to lay out the full framework. I hope to see you then.